Hello, this is Jason Wink, and thank you for taking a peek at today's market update video. It is Friday, December 12, and the market's just closed about 20 minutes ago. It's about 4:20 p.m. And wanted to show this chart. This is a one I've used a few times on my blog and on the formulafolios.com blog. I'm doing this a little bit different though. I've moved this chart into an application that allows me to draw on it in real time. So what I'm going to do is pull up my drawing tool and walk everyone through a couple things that are happening in the market currently. All right, so one of the things we can see is this green line that's on here. This represents the 2-year trend the market had been in really ever since the start of 2013. Each time that it had a sort of a drop, it would kind of fall on that as support. And you can see I drew in these blue circles. Those are representing each of those points where the trend line was tested. Now, in the beginning of October, you can see this blue circle here. The S&P 500 hit this trend line. It failed to bounce off it and go higher, and went down to set a sort of new non-trend low. When this happened, it's hard to know exactly how the market will react. I assumed that what would happen is somewhere around this point here would act as the new resistance, simply because it had been a spot where the market had stalled out a few times. And it turns out it did come pretty close to that level before bouncing and moving to new all-time highs. So the new all-time high, by the way, is really a critical new resistance level in the market. We can see that the prior all-time high happened right here. So a little arrow there. And what's happening today is the market's fallen below. It appears that this 2-year trend is now changing. So the significance of this really is just that what we've been enjoying for a couple years is just changing. It doesn't mean that we're going into a downtrend, just that the trend will be different. And what's happening here is this prior all-time high is now being tested. So when the market broke through this level, went up, hit a new high of around 2075 in the S&P 500, it's now fallen down, and it's right about this same level as the prior all-time high before this. Now what will happen next will shape really the next trend in the market. And so it could be a number of things that happen. If the market falls, and let's just say that it gets down somewhere around 1950 or thereabouts, let's just assume that this line continues downward and stops somewhere around here. And if from there it then starts a new trend and goes up, what we would know is that, okay, perhaps a new lower level trend is forming, which would mean drawing a line through this, and that new low that might form would be the new baseline that we'd be operating on coming into the new year. It's hard to know if that will happen because we have to see if the market does in fact kind of move into a new low or not. It could obviously bounce from right here and move higher, and again, in which case we would draw the line from here and go up. In a nutshell, we have to be a little bit patient to determine if the market will find some footing and then recover and move to a new all-time high. So in order for a new trend to establish, by the way, if it's going to be an uptrend, the market needs to find its footing. So let's just say again it comes here, and then when it moves higher, it needs to move into a new all-time high. So it has to get a point higher than the previous all-time high. If it doesn't do that, then we're still sort of in no man's land where we don't know what the trend is. It makes it pretty hard for anybody to forecast the direction of the market. Fundamentally, the market's still fairly healthy. Price to earnings ratios are reasonable. A lot of the holiday sales data has been good. Consumer confidence is high. So when we look at the underlying sort of economies that drive the market, those aren't really the problem. What's happening right now is simply the trading patterns, which are oftentimes controlled by computer programs. A lot of hedge funds and institutional investors are using those. What they're doing is some pattern recognition, same type of stuff that I'm teaching here today. And once they recognize the patterns, they tend to shoot an awful lot of volume into the market to help make them more well established. And the individual investor oftentimes is left a little bit out in the dark because often they don't have access to the same sort of supercomputing power. But all this is actually relatively simple. The big keys here is that just because the market's had a few down days, today was a rough day. People will see over the weekend, if they watch the news, that the Dow dropped 300 points. 300 points seems like this huge drop, but just keep in mind that on a relative basis, the higher the market goes, a 200-point day is not as big a deal today as it was perhaps, let's say, 4 or 5 years ago when the market was, half of its value. So in percentage terms, the market dropped 1.6%. That's a pretty large decline for one day. But again, it's up 50% over the last 2 years. So dropping 1.6% isn't a whole lot in relative terms. So we'll be keeping a close eye on this and trying to see where the market finds its footing. For now, what we're in is what I would call, again, a bit of a no man's land where the next direction is yet to be determined. And as far as the level of pain one might want to ensure they endure, essentially, if you go below this previous low, so you can see the last low that was hit was around 1850. This is how much patience you need to have if you're going to be a stock investor. You have to be willing to let the market drop down at least to that level. If the market breaks through that and goes down further, usually what that means is you have a series of lower lows. Could mean that the next trend is actually a downtrend. Again, if this for some reason is to drop, I'll just draw it in so you can kind of see what that might look like. If a new low is established, then you'd go from this high and you'd have a new pattern. Again, you can barely see it on the screen here, but that would be what would happen. But we don't know that until we see if the market falls through this previous low. If it doesn't do that, then it's just a matter of where does it stop and go up? Will it break into a new all-time high? And hopefully the good times continue to roll. So have no fears over the holiday season. Just enjoy your time. Know that it's perfectly natural if the markets are up for 5 or 6 straight years and the gains are 50 to 150%. Markets don't go up perpetually. We've seen a lot of people sort of chasing returns this year. That's always dangerous. In other words, the best performing asset class this year has been U.S. stocks, and it's amazing how only after they've had all this rally, we've seen a lot of people making comments or statements, questioning, hey, should I have more stocks in my portfolio? Or some just flat out sort of demanding, hey, I'd like more stocks in my portfolio. Why would I have cash, or why would I have bonds, or why would I have short-term treasury bills? Because this year and really the last couple of years, those have been out of favor. But when the market goes down, it's amazing how people's tune sort of changes. So we rely on a very mechanical, academic-based process for all of our investing decisions. When I share these videos, it's really just designed to help see a little bit what I see behind the scenes and how our portfolios are being driven. And right now, we're staying patient, waiting for that next pattern to develop. And if the markets decline a few percent, that's sort of the price of admission. You can't get all the upside without having a little stomach for some downside. Good news, though, just if you're a client of our firm, just know that we've actually weathered this little drop quite a bit better. Doesn't mean we haven't had losses, but in our growth portfolios, we've had a little bit of real estate. We've stayed away from non-U.S. stocks and commodities, which have been really, really beaten up this year. And so we didn't have quite as large a decline these last few days. On the bond side, we've stayed away from the high-yield bond market now for a few weeks. That's been very helpful as the high-yield bond market is really just kind of reeling at the moment. So it's been great not having those asset classes. As a result, you'll still have some losses, but they're muted some. So you're getting less of the downside than the broad markets, which is something we're really proud of when we're able to do that. So again, hope everyone has a great weekend. Thank you for watching this update. If you have any questions, of course, you can always go to your financial advisor. Or if you want to ask a question directly on the blog, there's a comment section below where you can shoot a comment in, or just use the Contact Us feature to get a message to our team. Thanks again for checking this out. I'll keep everybody posted as soon as we know a little bit more about where the next trend is going to take us.